Hello, ladies and gentlemen, and in honor of the Labor Day holiday, I'll try to keep this video shorter and more precise and to the point. Basically, we are at 87 in the model score on risk dials, and that tells the story. Equities over bonds and lower volatility. So without further ado, let's have a look at what the bonds are saying, and I think the message there is quite clear. Let's start with the only thing that's actually moving, and that is the move index. Haha. Well, it's quite clear to me that the move index is going to trade lower and lower over time, and that is basically saying that we are reaching an equilibrium point in bonds, i.e., that rates are going to stay high but not higher. The Fed is, I think, happy with the situation. The data that we are getting about a slight moderation in the employment situation, i.e., that the economy is not accelerating as such, employment is not accelerating but it's moderating, probably means that the Fed is going to be on hold for an extended period of time and then slowly start the cutting cycle. That should bring down volatility and a steeper curve over time. So let's have a look at what the individual tenures are saying and what the yield curve says. Starting off with a 2-year, it's quite clear to me that basically it's stuck between 0 hikes and 1 hike. So we're going to be trading between 475 and 5 or just over it. If we have a 70% or so chance of a hike, we will be trading around the 510 area. So we are stuck between 510 and 475, which is like a 0 odd of a hike. And I think that what happened on Friday is quite indicative. We got to 0 chance of a hike, straight back up, because you never know. But I think that we're going to moderate here and trade between 475 and 5% for an extended period of time. And I think the 2-year is going to be the one that's going to see the least action, because I think the odds of the Fed doing something over the course of the next couple of months are going to recede further and further as the employment situation does not get any worse, but also as the inflation figures that are coming out in 2 weeks' time show that there isn't enough improvement for them to start cutting the cutting cycle just yet, because real rates need to remain high for an extended period of time to make absolutely sure that there is no reacceleration of inflation in later periods. So I really think that the twos are completely stuck. If we look at what the fives are doing, they're stuck too. I really would not expect them to trade much higher than 437 to 440, and really no lower than these kind of levels around 408, however good the news is. The tens, I think they have still a natural bias to go towards 428 and then finally towards higher levels, just like the 30s. The 30s bounced off this 419 level like nothing. And I still think that over the course of the next few weeks, because we do have 30s and 10s auctions, not this week coming, but the week after, with CPI, are going to have a natural tendency to go up in yield until they've reached an equilibrium level which is higher and therefore with a steeper curve. Let's do a very quick run through of every single 2-year against everything else. This is twos, threes. To me, this is rolling over. Twos fives, to me this is rolling over. Twos tens, to me this is rolling over. Twos twenties, this is rolling over. Twos thirties, this is rolling over. Okay, let's have a look even at fives thirties. To me this is rolling over. So it's undeniable that the tendency is for the yield curve to steepen. Why is the tendency for the yield curve to steepen? Because twos are stuck. Twos are going to be trading in a 20 to 30 basis point range, even less than that. I would say a 15 basis point range, going from 10-15% of a hike, odds of a hike, and 50-60% odds of a hike in between there. What is going to be very interesting is what the dot plots do then for 2024 and 2025 when the Fed meets again in whatever it is, third or fourth week of September. But that is still good 2 weeks away. So in the meantime, what can the twos do? Not very much. There isn't a single piece of data that I've seen in the past 2 weeks that says the Fed should be hiking right now in September. And I think it's going to be quite an easy meeting for the Fed unless the CPI is very bad. It's going to be an easy meeting for them to say, nothing done, we are watching data, we'll continue to watch data. And unless the data really starts reaccelerating, and I can't see unemployment reaccelerating right now, there doesn't seem to be a reason for it, then we are probably at the end of the hiking cycle and we are at terminal rates. When we're at terminal rates, the odds of twos doing very much on the upside are very, very slight, because all we're arguing about is when the Fed starts the cutting process. Let's have a look at the thing that I think is likely to continue going down and providing the opportunity for the curve to steepen, which is TLT. And it's only a question of supply. When the QRA came out, it was, where were we? It was right here. We were at, let's call it at 100. And we are now at 95, let's call it. So we've come down a good 5% on the supply issue. And I think that keeps on going. The supply is ongoing. So we will continue to wedge lower, bouncing off really important levels like this 88 to 89 level. So I don't see it going a million miles to the downside. If we have a look at what that means for the 30s, that means a top somewhere around here, make a slightly higher high, get everybody out, and then back down. So it's a steepening tendency for the curve, with the 30s doing worse rather than the twos doing much better. Twos are stuck, 30s, I still think they keep on doing worse over time, simply because of the enormous supply of duration that's in the pipeline. The situation in Germany is not dissimilar. And just looking at a chart of the Schatz, you can see that we are very, very close to a top, and that we are nowhere near the impulsion that we had throughout 2022. We have been stuck now in a 30 basis point channel here for the best part of 3 months. That tells you that this market is losing all impulsion, and that the odds of greater Fed hikes by the ECB is basically receding by the day. If we look at the fives, we can see how important this level here is, which, this 245, 246 level, which corresponds with the level that I gave you in the futures around 2025 in the Bobble future 116, 2025. That is the level that it needs to break through, and I think it's going to take its sweet time to do so. But when it does, that's probably the start of a big move down towards this 212 area. In the meantime, it's going to stop people out around here, 262, 265, and then it's going to come back down. To me, this is utter stability in the 5-year sector, which tells me that there is no pressure on 10s or 30s either. You know, are we going to go to 257, 265? Probably, but I think the odds are that from there we roll over again. Germany is not where the pressure is going to be. Germany is the one that has the worst economy in terms of potential recession, and the one where there isn't really all that much issuance. So the differential should be going out. If we look at France, which technically trades extremely well, you can see that basically we have been exactly in the same, and we haven't moved a tick in the best part since April. So, or even going back since February, or even going back since, December of last year, i.e. we have not moved a single tick for the best part of 9 months. Okay, so what does that say to you? I think it says that European long-term rates have found an equilibrium. Let's have a look at the differentials between Europe and the US. Twos in Germany. This is the one that probably has the least room to move up. But if we have a look at fives, I think we could easily trade around this 190 area. I think if we have a look at the tens, I think we could easily trade at this 173 area. But the one that's probably the most interesting at the moment is the 30s. I think that can reach also the 173 over time, because the issuance is in the US and we have 30-year bonds being issued the week after this one. And that seems to be an equilibrium level, this 173, that, we reach all the time. However far back we go, we seem to see that this area between 173 and 192 is where the equilibrium lies. And that to me is the path of least resistance for the market, because of the supply in the US and the state of Germany. So I'm more, it confirms my view that with the very low move index, which is going south, which is trending down, that is also saying that the short end is unlikely to move very much. So, because the Fed is unlikely to move rates for a considerable period of time, which makes the twos stuck because they can't move without the short-term rates moving themselves, which are controlled by the Fed. And if it doesn't allow the short-term rates to move, the twos are really stuck. But what isn't stuck is the longer end, which can be pressured by the supply, both the treasury issuance, but also the corporate issuance. And we have a very heavy corporate calendar developing over the course of the next few months. That combined, and with the fact that banks don't need to buy duration, if anything, they need to sell duration, to me is a natural curve steepener and a natural buy German 30 years against US 30 years, because we're likely to move up towards this range of 173 to 193. It just makes sense to me to avoid the 30-year sector in the US and to prefer anything else with long duration. Given what I've just told you about the differentials between Germany and the US, and the fact that duration in the US is going to be sold against everything else, it seems to me only natural that the best you can expect in the dollar is stability, and the worst is an appreciating dollar. In terms of the dailies, going and taking out these highs around 104.70, stopping people out, probably getting towards 105.27, coming back down, but eventually trading towards this 106 level over time. I think now that we've bust through and we are keeping above the 200-day moving average, with all the other shorter term moving averages turning, basically says that we've seen the low in the dollar for this year, and the likelihood is for a higher dollar towards 106 towards year end. Where did we start the year? We started the year here, and we are, basically back where we started the year. It would make sense to stop everybody out who has been short dollars all year and trade towards this 106.25. Not next week, naturally, but this is now the weekly chart. Okay, and do we have room to go up towards 106 in the next 2 or 3 weeks? Absolutely. I think that is perfectly consistent with my view of interest rates, and it's perfectly consistent with the fact that the US is going to stay at high rates for longer, and therefore there's more to discount. There's a longer period of higher differentials between Europe and the US to discount into the price of the DXY. That makes sense to me. I think those differentials are going to remain elevated for a very long period of time, because the supply in the US is just going to get worse and worse over time. Let's start off with oil, and as you can see, it's definitely broken the downtrend. I don't think it accelerates. I think it's going to find natural sellers around this area, around the 88 to 90 area, and it's going to basically trade around on the weeklies between 75 and 90. So it's not, to me, an acceleration that we are looking for, and I'm quite happy that it's going to allow DBC an opportunity for higher prices, but not much higher prices. So let's have a look at DBC. It's closed above 24.39. Where would I expect it to trade over the course of the next 2 or 3 weeks? Around this 25.80-90 area. Would I think it goes much higher than 25.80-90? I don't think so. I think that is about as good as you get. You could get a brief foray into the 26s, but I would definitely be completely out. This certainly indicates that it's going to go higher, but by 26 you really should be out, and that's a 3% move. So that's, an easy 3% you should be able to make by buying any kind of a dip below 24.39 next week. Gold against DBC, it's, could it break down to below here? Yes, but I don't think it's sustainable. I think gold and DBC now will trade more or less in parallel, and the underperformance in gold at some stage has to stop. I don't think gold is going very far, and let's have a look at that next. All I can say about gold is that it's probably going to outperform TLT. Not much else. I don't think it can go up very much if the dollar is strong and TLT is wedging downwards because of the supply. It might outperform TLT, but not by a million miles. And therefore, my preferred side has to be this downside. All that we've done, in the past couple of weeks is basically correct an oversold situation, and now getting into an overbought situation with the stochastics turning over and possibly the MACD turning over as well, saying to me that we are very much stuck in gold and that gold is not going anywhere at all in the short term, which basically coincides with my view of DBC, that if it goes up, and I think it will, it goes up to these levels in 2560s up to 26. It doesn't go a million miles and it does not accelerate. I think accelerating commodities in a period of Chinese economy weakness and moderation in the employment situation in the US and weakness in the employment situation in Europe and the economic situation in Europe are more a monetary factor, i.e. people getting out of other assets and buying commodities rather than a sign of robust economic growth and demand. So I'll be wrong, but anything that I have in commodities that I've bought around here, I'll be out by the time it trades 26. And gold, I'm just not touching. I just think that it's far more likely to trade downwards than upwards and breaking this 2000 level. I just can't see that for the foreseeable future. Of all the asset classes, I mean, equities, you don't need me to say it. You can see it by yourselves, are the strongest. If we look at a monthly chart, because it's a new month, we see that the top that one does not want to be long over is 46.85. That's the level. Above there, it'll come back without a doubt. So that is all that can be said, apart from the fact that we keep on holding and closing above the moving averages. That is a sign of strength. I just can't get really short of it, and it makes very little sense to me that we can keep on going up. But that is the fact, and I'm not going to fight it. And I'm going to show you now why I'm not going to fight it. Analysts keep on upgrading earnings, and that's what's shown in these blue angels, where these lines are very much going higher. Basically, what we are getting is growth of around 12 to 15% expected in 2024. How we're going to achieve that, I have no idea, because if the economy is moderating, I really can't see how this growth can keep on going up at this rate. Really can't justify it even to myself. I whatever maths I do, I just can't see how we're going to have a 12 to 15% growth in earnings next year. I just can't see how it's going to happen. But while the analysts are doing this, the odds of the market turning down are very, very low, because unless bonds start breaking out to new highs, the stock market isn't really going to care if the yield curve steepens 5 or 10 basis points. That's not really what the stock market cares about. TLT can go down 2 or 3 points, but unless it starts accelerating down, unless 30-year yields start shooting up to 460, 470, the stock market isn't really going to care about that. It might care by 1%, but it's not going to care by 10%. This will keep on coming up as these analysts keep on, looking for stronger earnings into 2024 and 2025. At some stage, this stops, but I don't think it's going to be in the next week or two. If we look at a shorter term chart, it becomes pretty obvious that for this market to have any impulsion to the downside, it has to break this 44.60 to the downside. This is also where all the moving averages are going to be concentrated, and actually in a couple of days' time, also the Bollinger Bands will be up here. So it will be the only chance this market has of trading lower. If it doesn't break 44.60 next week, I think the odds become very high that at the very least we test the highs. DJI monthly, and the market gods are funny, aren't they? Let's enlarge this for you. What did I say? Monthly close, what above? 34,590. That's where we bought it, closed above. I think the odds are this month that we go and test the upside. And that would allow SPX to do it, because if the Dow is going up, SPX is going up for sure. And even if bonds go up in yield a little bit and that suppresses the Nasdaq, that still allows SPX to go and trade this level here around 36,300. Basically, in terms of assets, you are preferring equities, and you're preferring commodities, and you're preferring the dollar to bonds. I think that is really the clearest and simplest. Bonds are going to be going up least. The MOVE index is going to continue to come down, compressing the movement in bonds, while that, allows vol targeting funds to keep on pushing equities. If we look at the foreign markets like Nikkei and stocks and DAX, none of them are really looking particularly bearish. You can argue that this is a flag, a bull flag, that when it's broken, it's going to go a lot higher in Nikkei. On the weeklies, that is very orderly behavior. Basically, it's traded between 34,000 and 31,500. That's, a tight little flag, and easily could break higher. I think my objective is around 36,000. If we look at something like the DAX, even that which is the weakest, it's still not impulsive to the downside. It's still holding the 200-day moving average. It's holding within the Bollinger Bands. It's doing nothing particularly wrong. It's just the weakest of a very strong bunch. If we look at stocks, nothing much to say there. It's still holding every single level it should, like 42.26. It doesn't close below it. It might not close above 43.66, but that doesn't mean that it's impulsive to the downside. And if the market that's going to exhibit the worst growth over the next whatever period, i.e. Europe, is not going down, that tells me that the likelihood of the S&P breaking to the downside, while analysts are re-rating earnings for next year by up to 12%, is very, very low. Let's conclude by having a look at the VIX. I think this kind of behavior in the VIX is not indicative of a market which is anywhere near an important turning point in terms of rolling over. And it triangulates and confirms what I'm seeing in the bonds, what I think is the way forward in the bonds, i.e. a steepening yield curve with the pressure being exerted on the long end, and with equities which are going to outperform the bonds. And basically, VIX trading somewhere between 15.5 and these lows around 12, 12.5. If we look on the weeklies, this is, as low as we've been on the weeklies. Can we go down to 11.5? Sure, but that basically says that we are in a slowly upward trend in equities, with any serious fall of 1% or 2% being the maximum we can expect on the downside for the time being. I've updated all the levels. I think in a period of low volatility in both bonds and equities, it's very important to be surgical with levels, and that is what we need to do. I think the opportunities next week are going to be few and far between, simply because we have very little data. It's almost, no data at all. We only have one piece of important data, which is the ISM, and everything else is very secondary. Let's wait and see what happens the week after that with the supply of the 3s, 10s, and 30s, and that is when I think the yield curve can start steepening again. Thank you very much indeed. Have a lovely Labor Day holiday.